Thank you for attending. I'm Tiffany L, Outreach Specialist with the U.S. Black Chambers Incorporated, affectionately known as the national voice of Black businesses. We represent over 140 Black chambers of commerce and small businesses across the nation, and are founded on 5 pillars of service: advocacy, access to capital, contracting, entrepreneurial training, and chamber development. This series was crafted in collaboration with our chambers of commerce, providing technical assistance and resources to businesses across the United States with the U.S. Small Business Administration, SBA Community Pilot Navigator Program. Thank you for your assistance in developing and sharing this program. We are pleased to have Wells Fargo advisors present Planning Your Business Future. The support provided by Wells Fargo over the years has continued to help Black businesses and our chambers with resources and growth strategies that build revenue and sustainability. And today is no different. We would like to thank our partners in business banking, Wells Fargo Open for Business Technical Assistance, and the Wells Fargo advisors for their commitment in helping businesses achieve success. Today, we welcome you to this virtual summit of financial experts that will share strategies to increase your bottom line. Before we introduce today's first speaker, I encourage you to drop your questions into the chat, and we will address as many as possible at the end of today's webinar. Our first speaker is Mr. Scott Wren. Scott is Senior Global Market Strategist for Wells Fargo Investment Institute, WFII, a subsidiary of Wells Fargo Bank, which is focused on delivering the highest quality investment expertise and advice to help investors manage risk and succeed financially. He is a member of the Investment Strategy Committee, which is the team that produces strategy and guidance recommendations. Welcome, Mr. Scott Wren.
All right, thanks, Tiffany. Good afternoon, everybody. What I want to talk to you about today for the next 15, 20 minutes or so is just what our outlook is in terms of the economy, interest rates, what the Federal Reserve is going to do, and what it might mean for the stock market. So let me tell you first that, as much as I'd love to have a bunch of good news that I can tell you is going to happen over the next month or two, I really can't do that. And the reason I can't is because our base case is that we are going to slip into a recession here. Now, the good news, and we'll go through some numbers and things like that, is that we don't think it's going to last very long. And by the second half of next year, I think there'll be some brighter skies on the horizon. But in the near term, the economy is slowing. It's going to slow into the middle portion of next year. If you would have asked me 10 months ago, something like that, when I thought the recession might start, I would have told you we'd probably be in one right now, mid-year, a little bit after that, something like that. So, the timing, at least for us, the timing on this particular recession has been difficult, but nonetheless, we think that we're going to see a recession. So why is that? Well, probably the number one reason is because the Federal Reserve is aggressively hiking interest rates. They've really, for the last 4 meetings in a row, they've gone ahead and hiked interest rates 75 basis points at each meeting. Excuse me one second. Sorry about that, guys. That's one of the things working from home. That's our 9.5-pound killer attack dog there. I'm hiding down in the basement, but she was a little too loud, so I apologize. So Federal Reserve's aggressively hiking rates here. Inflation, obviously very high, much higher than what any of us would like it or what the Federal Reserve would like it. They've hiked 75 basis points in a row. That is a very aggressive hiking path, and they're not finished yet. Now, I think we would argue that they're about to slow that pace. Next month at the December meeting, we think the likelihood is that they raise a half a point, so 50 basis points, and they probably have a couple more to go next year in the early part of the year. The problem is the Fed has a terrible track record of slowing the economy without causing a recession. So what typically happens is the economy starts to accelerate, which it did to some extent for a portion of the post-pandemic environment, but inflation climbs. Now, in this case, there was a lot of cause and effect with the pandemic and inflation. Inflation really surged to levels much more than what the Fed would like. So they were behind the curve. They were slow to start hiking rates. They typically would hike rates too high, leave them there for too long, and the economy would slip into a recession. So that's exactly what we think is going to happen here, because the Fed really probably 85% of the time, if you look back over the last 60 or 70 years, they have not been able to raise interest rates without causing a recession. Another thing that's still a problem, and I'm sure many of you on the line know this, is the supply chain. Now, that's the supply chain for goods, raw materials, as well as labor. So the supply chain is clearing up. It's better than what it was. There's a lot fewer ships, let's say at the port of Los Angeles, waiting to unload goods. But there is still a problem. And some of you may have seen Mary Barra, who is the CEO of General Motors, a couple of weeks ago. She made that they are still having trouble getting semiconductor chips for cars, and that's negatively affecting car sales in a big way. Any of you that have maybe bought new cars or tried to buy new cars lately know there's not many cars on dealers' lots, and you might have to wait 2, 3, 4 months for delivery of a new vehicle. So that's a problem. It continues. We expect it to get better, but it's going to take time. And then, of course, the labor shortages, that's a headwind for economic growth as well. And I'll give you an example. My wife and I, a couple of weeks ago, went out to dinner at one of our favorite restaurants, which is near our house. We walk in, the host says, well, it'll be a 45-minute wait for a table. I look over, there's 3 or 4 empty tables. They're all set. They're ready to go. They have a candle on them. Can't we sit there? And you know what I'm going to say here. The host said, I'm sorry, but we don't have enough workers to basically give you the level of service that we think you deserve. So, we're basically going to have to wait. And so that's just less business getting done. But the main cause of the slowing economy is the Federal Reserve. It just, the Fed wants all of us out there spending less money. The supply of most things, whether it's labor or raw materials, is tight, and the only thing they can really do is try to affect demand, create headwinds for demand. And so that's what they're trying to do. What have we been doing about it? Well, since early March, and really most of March and April, we made some adjustments to portfolios to make those portfolios less sensitive to the ebb and flow of the economy. So we've been more defensive and less cyclical. So if you think of it in terms of an asset class, let's say something like emerging markets. The emerging markets are very dependent on the developed world to buy stuff from them. Are their wages rising? Yes. Are they more and more people going into the middle class? Yes. Do they want the same things that most of us take for granted? Washing machines, a car, Cuisinarts, all that kind of stuff? Yes, they do. But the fact is, those economies are extremely reliant on the U.S. And the rest of the developed world buying their goods. And if the economies are slowing here and abroad, we're going to buy less of it. So we're not fond of emerging markets. If you look at smaller capitalization companies in the U.S., the Russell 2000 index is a small capitalization index, and that's what we use to track smaller cap companies. They tend to be more risky. Their balance sheets don't tend to be all that strong. They don't have as easy access to credit. They're not buying back shares. They don't have a lot of products. And so they're more susceptible to a downturn. So we've been underweight there, or unfavorable on that as well. If you look at sectors, and what I mean by sectors is Standard & Poor's categorizes all stocks into 11 different sectors, and we make recommendations based on those sectors. For instance, technology, healthcare, industrials, those types of things. If we think the sector is going to do better than the S&P 500 index as a whole, then we're overweight or we're favorable. If we think the sector is not going to do as well as the S&P 500, then we're underweight or unfavorable. So we make a recommendation on each of those 11 sectors based on what we think the outlook of the economy is going to do. So in terms of sectors, once again, we're trying to reduce the amount of exposure that portfolios have to the cyclicality, to the ebb and flow of the economy. So we reduced industrials, financials, consumer discretionary, real estate. And just so that we're all on the same page, let me give you an example of an industrial. This is not a buy or sell rating or recommendation or anything like that. Caterpillar. I live in St. Louis. Caterpillar's headquarters are a couple hours north of us in Peoria, Illinois. You know, they make bulldozers, dump trucks, diesel engines, track hose, all those kinds of things. They operate in about 140 countries. And when the global economy is good, Caterpillar's doing pretty darn well. When the global economy is not doing well, Caterpillar isn't doing well. So industrials, that sector tends to be very broadly diversified globally. So we think we're having a global slowdown. We downgraded that. Another sector that I mentioned that you might be curious as to what that is the consumer discretionary sector. So that's the money that all of us, that's what we do with money, not that we spend on things we need. That's consumer staples. You need those. Consumer discretionary is things that we buy because we want them. So if you feel good about your job, good about the economy, good about your neighbor's job, basically you think things are doing pretty well, you're more prone to buy a new car, buy new furniture for your house, put in new carpet, remodel in general, all the kinds of things you wouldn't do if you thought that the economy was going to roll into a recession. You might lose your job. Your income was going to go down if you're retired, or inflation's very high and you just can't get as much for your money. So that's consumer discretionary. And all of those things are very tied to the economy. When the economy is doing well, those sectors are doing well. Now, as far as the numbers, and I don't want to bury you with numbers here, but part of my job is to do that, to be honest with you. As far as the economy goes, we think we'll see a little bit of growth this year, 1.6% in GDP, gross domestic product. But we think, as I said, there's going to be a recession next year. We're looking for a contraction a little bit more than 1%, 1.3. So we've been calling that a moderate recession. And I think one thing that the market has been concerned about with the Fed hiking interest rates is, are we going to have a mild recession, a moderate like we expect, or a severe? And so, the market would say, I think, overall, that the question's still out on that. That'll take a while to solve. So we're going to see a little bit of contraction next year and a little bit of growth this year. Remember, we have a $22 trillion economy. Historically, over the last 80 years, it's grown on average 2.83%, something like that. But that's a big economy to grow 3% a year. So in my personal opinion, once we get through these things, and it might be a year or two before we do, if the economy could grow 2% and not have a lot of inflation, I think stocks and businesses can do well in that kind of an environment. Now, inflation, which I talk to a lot of clients, I do a lot of presentations. All of us go to the grocery store, gas in our cars, and that's where you're reminded of what inflation is every week when you do those things. So the good news is inflation has started to come down. At least initially here, it's coming down slowly. If we look at where inflation is now, we measure it by the CPI, the Consumer Price Index. It comes out every month. It came in at 7.7% for the month of October. That was just released last week. We think this is probably where it's going to end the year. Now, remember, 5 or 6 months ago, we hit 9.1%. That was a 40-plus year high. We're still, pretty close to that. Inflation is still really high based on where the Federal Reserve would like to see it. But the good news is we think inflation is going to start to fall off pretty quickly once we get into next year, probably closer to the middle part of next year. The economy is going to be slower. Unemployment, unfortunately, is probably going to be higher. Now, the Federal Reserve might not tell you that they want unemployment higher, but they do. We think the unemployment rate is going to go from about 3.7%. Our estimate is by next year, 5.2%. And so, if you look at the underlying situation there in the Fed's mind, if you have more people that are unemployed, they have less cash in their pockets. They're basically going to go out and spend less money. And once again, they're trying to use that blunt object, that hiking interest rates to slow demand. Part of that, unfortunately, is a higher unemployment rate. So after all of that occurs, we think we'll be somewhere in the 2.5%, maybe 3% range for next year's inflation. Now, that is a big fall from where we are right now, but I think it's realistic if you take into account, look at the price of oil. It's fallen from $120 or $30. We're at $85 today. There's been some wage pressure. We think that's going to deteriorate. I think you're going to see just price pressures ease with a slower economy as we move through the next year. Now, interest rates in general, I always watch the yield on the 10-year Treasury note. That's what prices for mortgages and things like that are priced off of. Now, if any of you have been looking for a house, or your kids or your grandkids have been looking for a house, you know that the rate on a 30-year fixed mortgage just this year went from below 3% in January. About a week ago was 7.25%. Now it's a little bit lower than that right now. But that is a big move in interest rates. Once again, the Federal Reserve wants the housing market to slow down. They want prices corrected there and went down a little bit. That would be fine with them. That all weighs on inflation. So we think interest rates, 4% is our number for the end of this year. We're a little bit below that today. We're a little bit above that last week. These interest rates have been very volatile. But I think the good news is the economy slows and inflation's lower next week or next year. We're expecting, let's say, 3.5% on the yield on the 10-year. So in other words, for us, interest rates recently have been very near what we think will be the peak. We think it's likely that interest rates will go lower. We think people who have been looking at CD yields or just longer term bonds where the rates have been really low for a number of years, encouraging investors to think about putting some money in longer term bonds. The rates are higher than they've been for a long time. We don't think they're going to go much higher there. So what does all that mean for earnings for corporations, for the S&P 500? Well, this year, I think there's probably going to be record earnings for the S&P 500. If you look at it in terms of numbers, last year, the S&P 500 per share earned about $210, $212 right in there. We've got a $215 number out there for this year, so you could call that flat to slightly higher. But once again, next year, when we see the recession, the modest recession, we think earnings will contract 4 or 5%. We have a $205 dollar number out there right now. I will say this, excuse me, both this year and next year, the consensus out on Wall Street, so basically the average economist's estimate of where earnings are going to be, this year I think is about $225, so we're below that. Next year, it's about $235. Once again, we're at 205, so we're below that as well. So, if we're wrong and earnings are higher, that's a good thing. And of course, all of you are business owners and you have that are business owners and all that. So the more money that companies are making, the better. They can employ more people, all those sorts of things. But we're probably going to have a little bit of stumble in that. And next year we see earnings, at least for the S&P 500. What's that mean for the stock market? Well, today we're trading the S&P 500, which I would encourage you to watch the stock market, not using the Dow, but using the S&P 500. You know, the Dow is only 30 stocks. It's a pretty narrow look at the U.S. economy, where the S&P 500 is 500 stocks, and it's a very broad look at the economy. We've got a 3,900 number out there. Today it's trading at about 4,000. So let's call it the market's about where we think it will be by the end of the year. You know, could we end up a little bit conservative? We could, but things have been very volatile, and you know, now we're down to a few weeks before the end of the year, 6 weeks, and anything can happen in a 6-week period. But let's just say we don't think the stock market's going to end the year too far from where we are right now. Now, are we probably going to see some volatile trading action? I think we probably will. But the good news is next year, once we get through this recession, and the stock market usually starts to turn up about halfway through the recession, which we think will last until, let's call it June, July, August, maybe something like that. So if you had to map it out, maybe March, April, something like that, the market would maybe start to recognize that, hey, inflation is going to be meaningfully lower. The Federal Reserve will have stopped hiking interest rates by then. As a matter of fact, we think in the second half of the year, they're going to be lowering interest rates. We've got 0.75% of lowering interest rates there. So the market tends to look ahead, recognize that there's likely brighter skies on the horizon, and we think that the S&P 500 will end around 4,400 next year. So that's a pretty good increase from where we are right now. Part of that also, and we don't have any 2024 economic estimates out, but part of it is going to be, you know, as we go through the second half of next year, the market continues to see good things happening, continues to see progress in 2024, and so the market ends on a strong note to end next year. So those are, I talked about some of the sectors and the asset classes that we really haven't been all that fond of. What do we like? Well, we like U.S. over international. I talked about us being underweight emerging markets and the reasons for that. We're much more focused on what the U.S. is doing. Usually the U.S. leads the world into a recession, leads it out. Now, I would argue, you know, Europe could very well be in a recession right now, but I think that our economy is going to continue to do better and has the potential to do better relative to these international economies. We like larger cap stocks, so S&P 500 type stocks over the small caps, which, as I mentioned, were underweight or unfavorable there. Some of the attributes I talked about with small caps, it's the opposite with big S&P 500 type stocks. They have very good balance sheets. They have good cash flow. They're buying back shares. They have easy access to credit. They have lots of products. That's why people hide there in uncertain times. The big companies that know how to weather the storm, that's where, you know, people have been, and we've been hiding. We've been defensive, as I said. In terms of those sectors that I mentioned, the ones we've particularly liked, we've liked energy. That's worked out pretty well. Energy is only a small portion or small part of the capitalization of the S&P 500, but still it's done very, very well. We like healthcare. So that's defensive because we're all going to go to the doctor, buy our medicine, whether the economy is good or bad. That's why people hide there. We've liked technology. Now that's been a tough one. That's about a third of the total value of the S&P 500. It's done worse than the S&P 500. What we would recommend is that clients, you know, you want to have some technology exposure going forward here. And if you're underweight technology, we're recommending that you bring that up to at least an even weight. So let's call it 28, 30%, something like that of a portfolio. We think these companies are going to continue to grow. We think interest rates are going to come down, which is going to help the valuations there. If you do the math, and with technology being about a third of the value of the total value of the S&P 500, it's going to be hard to get to that 4,400 level we're looking for if technology doesn't at least participate. It doesn't have to lead the charge, but it has to participate. Otherwise, it's tough to do the math to get to those kinds of levels. Other sectors that we've upgraded here, on the more defensive side, I mentioned consumer staples. So those are things that we need: laundry detergent, toothpaste, food. We're going to buy those whether the economy is good or bad. We've also upgraded utilities. Once again, you're going to turn on the lights, take a hot shower, heat and cool your home, whether the economy is good or bad. So those are some of the things that we've liked. Time horizon here, we think we're in for some volatility here in the near term. Let's say over the next few months, if your time frame is 3 months and you can't sleep at night because the market's making you nervous in the economy, you might want to hold on to that cash. Or I always use the example, or I have been using it. You have a big liquidity event. Your daughter's getting married. You got to write a big check, and holding on to that cash. But if your outlook is 2, 3, 5+ years, you need to take advantage of lower stock prices. The best time to buy stocks historically is when you don't really feel very good about buying stock, because it kind of makes you queasy. Your friends are nervous about the stock market. The media is nervous about the stock market. That's the best time to buy stocks, is when nobody likes them. Worst time to buy stocks is when you love stocks, your friends love stocks, the media loves stocks. You're standing in line at the grocery store and the two people in front of you are talking about how great the stock market is and how much money. That's when you want to lighten up. That's telling you, hey, this is a little too enthusiastic. So we're nowhere near now. Sentiment's pretty bad. We think it's going to improve over time, but certainly we want to buy stocks when they're down. I'll say this: we just got through the election. We've been a believer that we're going to have split government. So in other words, we felt like the Republicans were going to take the House. It's going to be much narrower than what we thought, but that still looks to be the case. Not guaranteed. It hasn't all been settled yet. But I think that what that probably means is we're going to have less new spending. So clearly. New spending, I think, is going to be tough right now. And whether you're a Republican or a Democrat, let's face it, when you have a $30+ trillion deficit, it's not because one party likes to spend money and the other one doesn't. They all like to spend money, okay? And so that's how you get to a deficit that large. But I think it's safe to say that there's going to be less new spending. Once again, we're assuming that there's a split government here with the Republicans controlling the House. And so that's the situation there. So really, what I'm going to do is open it up to some questions. I'm not sure if Tiffany wants to kind of moderate that, but certainly I went a couple of minutes over my allotted time, but I'd be more than happy to take any questions that anyone might have out there.
Excellent. Thank you, Mr. Wren. We do have a couple of questions in our chat that have come on based off of what you've been saying. I want to be also, respectful to time. Mr. Gregory Vernon, do you want me to save all questions till the end and we can come back, or should we hit these up really quick?
No, give Scott 2 or 3 questions because I know he is time crunched to other matters. Excellent. So give him his questions so he can move on, do other things.
Excellent. All right. Mr. Wren, given this current outlook, what are some practical steps small businesses can take to manage inflation? Pass on the higher cost to customers, ? Arrange flexible financing, ?
I think right now is and probably what a lot of people on this call have been doing is they have been able to do some price increases here. I think that everybody's had a tough time finding people to work. The people that they've probably found have cost them more than what they would like. I think for the time being and in the very near term, what I've seen in any surveys we've done is that businesses have had good success at passing through prices. People understand that inflation's up right now. And so I think that's one thing to do. Another thing I think is always good to do is just to refresh your relationship with your source of credit, let's say your banker, and just talk to the person who's covering you. understand what your liquidity needs are, make sure that they understand where you're coming from, so that everybody's on the same page here, because, if we're right, we have not hit the recession yet. It's going to come and go fairly quickly. Let's call it over a 8-9 month period, something like that. But it hasn't started yet. So I think it's best to try to, address some of these things ahead of time.
Excellent. The second question, I believe you've already touched on, based on the S&P, should businesses invest some of their profits in the stock market? You mentioned it's kind of low, so it's the best time to invest.
Yeah. I mean, I would say, Tiffany, like I said, the best time to buy stocks is when people, including yourself, do not like stocks. So the sentiment out there is pretty bad right now. You want to take advantage of these pullbacks.
Final question. What is your advice if I'm retiring in 5 to 7 years?
Okay, here's the situation, Tiffany, is we are all living longer. And that means that, we are all going to have to make our money last longer. And I think one of the best ways to participate in the continued growth of the global economy, which it's going to continue to grow, is through the ownership of stocks. So we're all going to have to be in the stock market for longer than past generations. And of course, you have to figure out, what's your tolerance for risk? I mean, if you're laying there in bed at night and can't go to sleep because you're worried about what the stock market's going to do the next day, you've got too much risk. But you need to be invested. There are multiple ways to be aggressively invested or much more conservatively invested. So I'd talk to your financial advisor about that. But that's an important thing, is you have to get a grip on what your risk tolerance is. And people always make the mistake in a market that's going up. They think my risk tolerance is pretty high. This is working out great. But when the market turns, and, let's face it, from the high, all-time record high this past January, we were down 25% at one time, which that's pretty much in line with what you see during a moderate recession. So, figure out what your risk tolerance is and be invested to match that so that you can sleep at night.
Mr. Scott Wren, we appreciate your guidance, your recommendations on strategy for investment. Next, we have our presenter, Mr. Greg Vernon, financial advisor with Wells Fargo Advisors, who is dedicated to helping individuals and businesses develop financial and investment strategies that line up with their needs, goals, and risk tolerance. His mission is to provide every client with a targeted, comprehensive financial advice and portfolio management. Greg is going to highlight ways to engage advisors, budget for retirement, and find paths to minimize taxes. Thank you, Mr. Vernon.
All right, good day. Thank you, everyone, for attending the conference today. We can go to the slide, I guess, personal finance designed around you. What I find working with various clients is there's interest on how to grow their wealth or grow their nest egg. And on the bank side, there isn't that many choices to choose. There's basically CDs or money market instruments, et cetera. Now, the bogey in the room that Scott mentioned is inflation. Everyone wants to grow their money faster than inflation, and historically it's run at about 2.5%, 3%, but now we're facing inflation at about 8%, 7.7 to 8%, which is, unreal. You have to go back 39 years to get to inflation at that rate. So it's funny, I have a client that's fairly wealthy, and he always tells me, Greg, I remember when milk was 25 cents. I remember when hot dogs were 50 cents at the baseball game. I remember when I could go to the baseball game, go see the Yankees for $20. He's like, none of that exists anymore. I remember, I could get a gallon of gas for $1.25, and none of that exists anymore. So to individuals that are looking towards retirement, and this, mind you, is coming from a wealthy individual. He's fairly wealthy. I said, Dr. G, why do you care? You're wealthy. It doesn't really matter. But he still remembers the good old days. He's probably talking about the 70s, late 70s, and prices. Those prices are still stuck in his mind. And now we have to look forward as prices are increasing ever so fastly. So let's go to the next slide. I want to go into how we work here at Wells Fargo Advisors and how we help clients grow their nest egg. So when you engage with Wells Fargo Advisors, you're dealing with a team-based approach. And what we like to do is take a full balance sheet approach, meaning we want to grow your assets primarily through investing, but we want to minimize your liabilities, meaning your lending costs. So you're going to have a team on the team. You're going to have a premier banker that's going to address all your banking needs. We have lending professionals that we work with very closely to minimize your borrowing costs, your lending costs, and then we have investment strategists, investment managers that tap into the wealth of knowledge of a Scott Wren at the Wells Fargo Investment Institute to help structure your portfolio to your risk tolerance and needs and goals. So that's in a nutshell how we work. Let's go to the next slide here. So some of the keys to unlocking your dreams here. This slide looks pretty plain vanilla. It becomes very interesting when you sit down with a couple. And so we have this presentation where we have cards where we give the husband a set of cards and we give a wife a set of cards, and they differ on what they care about the most here. So you might say, hey, I care about putting away for unexpected large expenses. And she might say, hey, I need a new marble kitchen. So where does that $40,000 to $50,000 go? That's a discussion that needs to be had. But this slide is pretty straightforward there. We can go to the next one. I'm going to run through because I want to get to Gary D. Wells Fargo Premier is something that we just rolled out in July. It is the experience that we're trying to give our clients, our key households that have 250,000 or more with us. If you don't, that's okay. We're still going to work with you to help get you there. We can go to the next slide. I'm assuming everybody's going to have this deck to read anyway. So let's go to the next one. All right, there we go. So this is what Scott was talking about, the market cycles. The reason why I love this slide is you look in any 5 to 10 year period, the market always ends up higher. So it just goes through the resilience of the market cycles. Like I remember in 1990, I was thinking about going into the military, and the Gulf War ensued, and I said, oh, you know what, I probably should just go to college. But that was a thought, and I just love this slide. It just shows you that over time you're going to tend to do better being invested well in the market, which is what we help you do. We can go to the next one. The expertise of Wells Fargo and the Investment Institute. Scott is one of the senior people there. There's 200 investment professionals there. They publish media resources, et cetera. What I want to do for this group is I want to disseminate some of their writings. I have to work with Lisa on that, Lisa and Warren, to get that to you. Because I think this presentation is more broad in scope, but I do want to pinpoint and get into further detail to areas of interest. So let's go to the next one. Okay, so I have brought on today because people have interest in retirement planning, vehicles or tax saving techniques, et cetera. I brought on a value-added partner, Gary DiLoretto here, and he is with John Hancock. And the reason why I chose John Hancock is they are number one in this particular space in 401ks and for small business, just like Wells Fargo is number one in small business lending. It's you know, I'm in LA. So in LA, I attended the LA Black Chamber of Commerce meeting recently. And it was funny because they gave the Bank of the Year award to B of A. And I said, you know, during the pandemic, Wells Fargo received $400 million from the government in PPP money, and we disseminated that. And the government also gave us another $400 million to disseminate that money to small business, and Wells Fargo donated that. So our total impact to the small business community was really large. And I think we were the only major bank that did that. So it just shows our commitment to the small business space. So I'm happy to introduce Gary D on, because he works with small businesses daily on structuring tax efficient plans for retirement, for business owners, and for your individuals that help your entity grow. So with that, I'll turn it over to Gary D.
Thanks, Greg, and thank you everyone for spending a few minutes with me today. As Greg mentioned, I work with John Hancock Retirement Services. I've been doing this particular role, working with small business owners and financial advisors for about the last 15 years. And what I want to go through today is some of those conversations I've had over those 15 years on finding the right retirement plan for those businesses that I talk to, because it's not a one size fits all product. It's more of what type of goals do you have for you and your employees. Warren, if we can go to the next two slides, one slide past this one, thank you. So when I go out and I speak with a business owner, everyone's goals are different. One business owner's goal might be to maximize tax deferrals for themselves and a few key employees. Another goal for setting up a corporate retirement plan is to attract and retain talent. And the other one is just to save for retirement. Those are like the three common themes when you're setting up a retirement plan. And for those people who don't have a plan set up now, but thought about it in the past, historically barriers have been, hey, it's too expensive to set up, or this is a really complex benefit. I don't really have time to manage it, or I'm not able to put away as much money as I would like. There's been, competitive balance has really driven down cost. And a lot of the regulations in our industry have made it a little bit easier to understand. We've disclosed a lot more information to our clients. So I just want to go through the different options today that you have as a small business owner to make sure that you have the right plan in place for yourself currently. And if you're thinking about putting together a plan for you and your employees, going down that right avenue, choosing the right plan that's best for you. Warren, if we can go to the next slide. Historically, small businesses have fell into these three types of retirement plans. Either they set up a simple IRA, a SEP IRA, or they have a 401k and profit sharing. And each has their advantages. And I'm going to talk a little bit about those advantages. So let's define what a small business is. The Bureau of Labor Statistics, it really defines a small business as 500 employees or less. When we're talking about retirement plans, though, the retirement plan industry as its own entity, we're really talking about 100 employees or less. I would say businesses that I speak with range from 4 employees to 4,000 employees, right? There's a wide range of companies that I'm talking with. And each one of these is going to be a better fit for those types of companies, depending on size and goals. A simple IRA, and this is depending a lot on what state you are in, right? In California, where I'm located, there's a state mandated law where if you have over 5 employees, you have to have a retirement plan for your employees. New York has a similar law, Connecticut and similar states throughout the country have laws like that. Well, others don't. So either you're going to take the state mandated plan or you're going to set up a plan like a simple SEP or 401k for yourself. There's benefits, pros and cons to the state run plans. We're not going to get into those today because I don't know what state you're in. I don't want to give you wrong advice. But a simple IRA is what the title says. It's simple, right? You're not allowed to put in as much money as you are as if you set up a SEP or a 401k, but it's a benefit just to get started. It really is the first introductory step into setting up a retirement plan for your company. A SEP IRA, and we'll go over the difference of the rules. A SEP IRA, in my opinion, and in my experience, it could be a good option for those tightly held companies. You don't have a lot of employees. The employees or the owners are working closely together. They could be family members. A SEP IRA might be a good fit for you as well on that one. The most common and most popular, especially in today's environment, is the 401k profit sharing plan. And the reason why it's become popular is twofold. Number one, a 401k allows employees to put in their own money from their paycheck, defer and save for themselves in retirement. And a profit sharing plan is a completely optional add-on that the employer can put in money for the employees as well as an added benefit. They don't have to, it's completely optional, but it gives the employer a lot of flexibility on how to design a retirement plan for themselves and their employees. So real quick, I was raised by my grandparents. My grandmother was a waitress. My grandfather was a school teacher. My grandma worked till she was 78 and retired on Social Security. By the time she was 78, she wasn't the quickest waitress, but she worked at a diner, so I don't think many people were upset about that. My grandfather retired, I think, when he was 55. I wasn't even in the house when he retired, but he retired on a teacher's pension, right? The reality, based on some of the data that we heard today, is most of us are not going to be able to retire on that. Most of your employees are not going to be able to retire on that. You have to offer them an avenue to save for themselves so they can retire with dignity. And it is a benefit that is being asked about more as you're trying to find people to work in your businesses. So having a really competitive retirement plan can really help with some of the gaps in maybe trying to find people to work within your business. So that's why I find this conversation a really important conversation. The other one is I go and talk to business owners almost on a daily basis. And when I'm talking to a small business owner, a lot of the feedback that I get is, I invest in real estate, I don't invest in the market. Or secondly, I'm going to sell my business. That's my retirement plan. Well, as you can tell in today's economic environment, you might not be able to find a buyer when you want to sell. So I would look at these retirement plans as a way to diversify your retirement planning. So if we can go into the next slide, Warren, I'm going to show you the difference between these retirement plans. Now I'm going to this slide is a little busy for the presentation that we're having right now, but I'm going to make sure everyone gets a copy of this. Greg, if that's through you, Tiffany, if that's through you, because I think this is the best slide that we have that differentiates the different options for you. So the first question I ask a business owner when they're trying to set up a plan or they have a plan and they want to reevaluate what they set up is, why did you set the plan up in the first place? And a lot of times is, I was just looking for a way to save money on taxes, because a 401k, the money comes out of your income that you pay yourself and it goes in to an account either as a pre-tax contribution before you pay taxes on it, and it grows tax deferred. So every year it grows, you're not paying taxes on the growth, or it goes in as a Roth contribution. You pay the taxes on it, it grows tax deferred, and you take it out in retirement tax free, right? So that's an option within the 401k. The SEP IRA it's completely employer funded, meaning I'm an employee, I can't put away money into a SEP IRA out of my paycheck. The employer has to put money in on my behalf. A simple IRA is I can put money in out of my paycheck, but it's the limit, the government limit is a lot lower than what I could put in for myself in a 401k. So if you have a high earning employee base, the simple IRA is not going to be a good option. They're going to be really limited on how much money they can save for themselves. A 401k would be a really better option for you. Once again, if you're just looking to put something into place where you're just trying to offer a benefit, but you don't know how much of the employees are going to actually enroll into the plan, a simple IRA might be the better option, right? And this is a conversation that you would have with your financial advisor, and then they would bring in a product partner like myself. And we would really ask you the meaningful questions to find out which one of these retirement plans is going to be the best fit for you. Now, the last one, which we haven't talked about, the last column here that we haven't really talked about, is what we call a defined benefit plan. If you're a business owner with a handful of employees and you're in your late 40s, 50s, maybe a little bit older, and you're really looking for ways to save money on taxes because you're having some really good years, this defined benefit cash balance plan might be a really good option for you, because this really allows you to supercharge your retirement plan savings. And once again, any money that is contributed by the business that goes into these retirement plans is a business expense. So you're not paying taxes on it. It's coming right off of your income. If we can go to the next slide, Warren. So for some of those that have retirement plans into place now and are utilizing a profit sharing plan, this gives an example of, we called HCEs. Those are people that the government defines as highly compensated employees. Highly compensated employee is anyone making over $130,000 a year within your business, or is a 5% owner or more, right? you can probably figure out pretty quickly who's an HCE. Everyone else that's not an HCE is a non-HCE, and they fall into the other category of being an NHCE. So when we're looking at this slide, I would say look at it as 3 owners and 8 employees. And if you look at the percentages on the bottom, that's the most important number in this slide. In each instance, the owners are putting away $112,000 for themselves. But there's different types of profit sharing plans that you can put into place. And if you're not getting good guidance, you might not put in the best one for you. So if you're just doing your traditional safe harbor 401k profit sharing plan, yeah, you're getting in the maximum of $112,000, but you're also giving your employees $50,000 to pass non-discrimination testing, right? So it's costing you $163,000. In the next example, which we call a permitted disparity profit sharing plan, you're still getting in the same maximum amount, $112,000, but it's only costing your business $150,000, right? It's more efficient. And then we go into the last profit sharing formula that we're allowed to use, the new comparability profit sharing plan. Once again, you're still maxing out at $112,000 for yourself as a business owner, but now you've really limited what you have to put in for the rest of the employee population. So this is what we call as the most efficient for the owners when it comes to putting one of these profit sharing plans into place. So you might have a profit sharing plan right now, and you might think that you're maxing out and you're in a really great situation, but you might not be doing it as efficiently as you possibly can. Trust me, I come across these opportunities all the time.
Gary,
now, yeah.
1 second.
Yeah.
I'm being told that we have questions for you.
Okay.
And we have to wrap this up in the next 10 minutes.
Oh, I can wrap it up in 3 minutes and then get to the questions.
Okay, awesome. All right.
Yeah.
All right.
Yeah. No, but thank you for the heads up. Trust me, I could talk about this all day, fortunately or unfortunately. But the point being is, if you have something set up, it's always good to check it with an independent financial advisor just to make sure that you have the best setup for your business. And if you're thinking about setting something up, really think about what you're trying to accomplish. Just don't set it up for the sake of setting it up, because there are a ton of options out there for you, and they're not as expensive maybe in the past as they once were. And there's a ton of tax credits that your advisor and myself will know about. So once again, the barriers to entry have really come down, and it's always good to reevaluate what you have set up to make sure it's meeting your goals that day. So with that, I'll hand it over for questions.
Excellent. Thank you. Wow. Mr. DiLoretto, Mr. Vernon, lots of financial wisdom being shared with us today. I can already tell I'm going to rewatch this a few times. There is a question in the chat to either of you gentlemen, Gary or Gregory. The question is, what is a good percentage of income that small business owners should invest in the stock market or other investments?
If it's general, like advisory, like if you're trying to just decide how much of your income you should be putting away into the market, I'm going to leave that to Greg. If you're trying to, a general rule of thumb is you should be saving 10% of your income into a retirement plan. That's a general rule of thumb, but that's if you're an employee. If you're an employer that's making $500,000 a year, you know, is $50,000 a year going to get you to where you need to be in retirement? Probably not. You probably need to save a little bit more money than that. So your percentage is going to be a little bit higher, right? And once again, we can actually work with your CPA, and they'll work with us to give us a number that is appropriate for you to put away, and then we'll get that money working for you.
That kind of rolls into another question. Are there different types of retirement plans that can maximize returns but have a lower risk factor? Sounds pretty specific to the client.
Right. So yeah, exactly. So 90% of retirement plans out there, regardless if they're SEP, simple 401k profit sharing plan, invest in mutual funds, right? I'm not going to go too deep into what mutual funds are, but that could be in the stock market, that could be in the bond market, and each have a different layer of risk associated with that. For the most risk adverse investors that we have out there, we have what we call stable value funds. And they are backed by the provider. So in my case, John Hancock, right? Almost works like a CD and has a guaranteed interest rate, very much tied to the 10-year note, a little bit more shorter term. And right now you're getting around 3.5% rate of return guaranteed by John Hancock on those investments, but you're not really keeping up with inflation, right? With that rate of return. So once again, to Gregory's point, if it's going to keep you up at night, you know, reevaluate what your risk tolerance is. but have an honest conversation with your financial advisor if 3% is going to get you the balance that you need in retirement, because we're living a lot longer now.
Yeah. I have clients that ask, oh, I don't want to lose money. I don't want to lose money. If nobody wants to lose money, the bank is not here to lose anybody any money. The fact of the matter is, if you're investing your money at 3.5%, and inflation is running 7.5%, you're losing money over the long term. Because like I said, those baseball tickets, the gas, the milk, the groceries, all of that, the prices of all those things are going up. They're going up exponentially fast in the short term, but even 20 years from now, you can expect those prices to be higher regardless, because there's just a latent inflation piece that's just going to be there. It's going to be the white noise in the background. I hope you guys enjoyed what was delivered today. I know we're short on time. Scott did have a lot to talk about. There's just a lot to talk about in the economy right now. So I hope that was very helpful. I look forward to working with you guys more to deliver content. I think Lisa wanted us to hone in on specifics, and I think Gary did a great job on giving you some of that. Feel free to reach out to me. You can always shoot me an email and I will get right back to you. We have a ton of resources available on our platform. Sometimes I tell clients, I feel like if you remember that show, The Love Boat, I feel like Isaac from The Love Boat. Like, we have everything here at Wells Fargo to take care of you. So just please feel free to email me. I had two other people to get on this call. Aaron Henry, who is our private wealth advisor. He works with our investment strategists, et cetera. So he works with tailoring portfolios for clients. And then I had Jock Bailey to come on for small business, because I think there were some questions on business succession planning. But I think that's another call that we could possibly put together on for those guys. They couldn't make it due to scheduling conflicts. But again, I want to say thank you for the opportunity to speak, and I don't want to go over time because I'm very punctual.
Excellent. Thank you, Mr. Gregory Vernon. The good and the bad news, right? We ran out of time. We've got a lot more questions, but our team here at USBC will make sure that we Q&A those, reach out to you, and we get those answered.
So what I want to do, if I see a trend in the questions, what I want to do is I'll forward over. Wells Fargo disseminates pieces on specific products, so I'll send that over to address things. But my email is there. Please feel free to email me or call me, etc., and I will get you an answer as soon as possible.
Gentlemen, thank you. Thank you for attending Planning for Your Business Future. This was possible through our work with Wells Fargo Advisors and the SBA Community Navigator Pilot Program, funded in part through a grant with the U.S. Small Business Administration. A tremendous thank you to you presenters, Mr. Scott Wren, Senior Global Market Strategist, Managing Director, Wells Fargo and Company, Mr. Gregory Vernon, Financial Advisor with Wells Fargo and Financial Advisors, Mr. Gary D.A. DeLoretto, Regional Vice President, Pacific Coast, John Hancock. And to our Community Navigator Chambers, thank you for advocating for Black businesses, and to you, our viewers, for sharing in this discussion. USBC introduced By Black, the only Black certification program with a business directory, providing businesses that certify access to private and public procurement opportunities, highlights, and other benefits. This online program can help prepare for the contracting space as documents preparation guide. Certify today by visiting usblackchambers.org/certification. We invite you to give us your feedback on today's session. Just scan the QR code or type in www.surveymonkey.com/r/bizfuture. Join us for upcoming November events by visiting usblackchambers.org/webinar to register for topics such as Ask Me Anything Reels, presented by MetaBoost, this Thursday, November 17th at 1 p.m. Eastern Standard Time. Get your local business on Google Search and Maps also on Thursday, November 17th at 5 p.m. Eastern Time, and much more. So follow us on social media, blackchambers.org. If today's forum prompted additional questions and interests, feel free to contact us at programs@usblackchambers.org. Thank you for joining today, and happy holidays.
Thank you, everyone.
Thank you.